lot of copycat businesses that have come out since over the last few years, and we've cornered the market in certain areas. There's really no mainstream commercial companies outside the global brands like Colliers, CBRE and that. Oh, it went viral, like where it was the most read story of the day. Millions of people saw it. It was translated into 12 different languages.
Time has been probably the greatest friend to your growth in your portfolio, I would imagine, as well as some shrewd and smart investing.
The compounding nature of property is really the true gain, and we're up to sort of 85, 90 mil in property, and the average growth rate of commercial for the last 30 years has been about 6%. So 6% on 90 mil now, you know, call it 5-6 mil growth you're going to get every year just from an average market.
G'day, how you going? Phil Tarrant, co-host Inside Commercial Property with Rethink Investing, part of the Rethink group. I don't know what you call it. Change every day. Yeah, always adding a new business. Scott O'Neill, director, founder, Rethink. How you going?
Yeah, good, mate.
Yeah,
Good.
yeah.
Similar to you. You've got about 15 different businesses.
Too many things.
I don't know. Why do you keep doing them?
I don't know. We're coming up to end of the financial year, and I just sit there and just go, here we go again.
That's why you have two accountants.
Here we go to two accountants.
Yeah.
But it's you can sit there and complain about it, but it's part of the game.
Yeah.
And if you make a few bucks in business, the smart people park it in property. Pretty much what we talk about on this thing. Of your client base, how many of them would be self-employed business people who are transitioning dough from one hand and parking it into a safe asset in another?
It'd be a guess. We did an actual survey years ago, but it's around 25%.
Okay.
There's a large portion of medical people as well. Like we've had 2 or 3 medical people in
That's right.
over the years, pharmacists and surgeons, stuff like that. So they make a good proportion, and it's just people that have invested from very little, built their resi portfolio, and then they've transitioned.
There's a lot of PAYG people, because I think it's a bit of a myth. People think, oh, well, commercial property is only really for the wealthy. Commercial property is only for people who are in business because they buy their premises. Commercial property is only for people who have been around for a long time and they've got family and generational wealth. So it's a bit of a misnomer.
No, I'd say the majority is just people on salary, because it is where the largest bulk of people are in the community. So, that's our standard client. And then obviously there's some business owners and some doctors that obviously can do very well and buy the higher value stuff. But as you said, that's where they come from. Now,
I've picked up my telephone, and those people who can see me, and I've typed in, Scott, Coronavirus Australia, 12th of June, 2020. And some people might ask, why is that an important day? And I'll tell you why, Scott. I'll tell you why. Number one, the National Cabinet just met, Scott, and stadiums that could seat 40,000 people were allowed to have crowds of 10,000 back then. This is back in the dark days of COVID.
Social distancing.
The Prime Minister on that same day, the 12th of June, 2020, he said there was plans to reconsider the safe return of international students. Okay, nice. Australia on that date also, 12th of June, 2020, Australia moves to a suppression rather than an elimination mindset when it comes to COVID.
That's right.
And if you remember, this is 3-4 months into COVID. And a lot of people were struggling. JobKeeper was kicking in the gear, and everyone was still in a frenzy. South Australia on that same day, Scott, set the date for reopening its borders. Think back to all this madness.
Closed. Wow.
Yeah. Sydney Public School was closed due to a COVID-19 case. That's what I was telling you. It was Rose Bay Public School, your neck of the woods. And at the same time, on that same day, the WA government renamed King Leopold Ranges into something else, which is completely non-COVID related. So if you think back then, it was crazy times. There was, at that moment, Scott, how many COVID cases do you think on that day in Australia?
Oh, wow. I haven't thought about case numbers for a long time.
Yeah, remember when they used to stand up every day and just do like as a cricket score, right?
Yeah.
On that day, on the 12th of June 2020, there was 7,290 current confirmed COVID cases.
Remember they used to track them like, they went to that chicken shop, or they went to they'd follow the dots around the city.
Yeah.
And you get locked down and you hope you weren't there.
And you sit there just go, did I go there? And I had to get locked up for, was it 14 days?
That's right.
It's crazy.
The wedding. Remember the famous wedding?
The famous wedding. Yeah, that's right. The super spreader event.
Yeah.
And 102 deaths up until that point.
Wow.
Maybe that was on the day. I'll confirm. And there was 6,783 cases were recovered at that point. 4 years ago, nearly, to the day. What's today's day? 18th. Yeah. But it was another very special day, Scott. Why was that?
Well, more importantly, we launched this podcast.
We did.
I remember catching up with you at the time, and we were discussing, is this really a good time to launch? Because all this stuff was going on, and like this was after the lockdowns and social distancing, and gyms were all getting closed, cafes were having, basically it was a disaster for commercial. It looked like worst case scenario. And we were just thinking, do we really launch this? Like, no one's going to be interested in commercial, at least from an investment point of view. It might be a bit of a sideshow because everyone's like crashing and burning and they want to find out how much pain there is. But it was you, to your credit. You said, "No, look, let's just push through," because I wanted to delay it a few months just because it was just a podcast. May as well just push it back. But I think that period is why it was successful, because it just launched. There was a lot of people sitting around with time on their hand. This is like this, when property in general started to explode. So we were at this stage where we're wondering how far would things drop.
That's what I mean. I think Commonwealth Bank, for example, was saying that it's going to be price drop
Yeah.
30+%.
Yeah.
Right.
Exactly. And then we had this theme throughout, because it's the whole long-term approach. They're very boring, don't worry about the next few months. It's still bricks and mortar. We'll get through it. Australia needs this stuff to work. But it was just fascinating how quickly people jumped onto this podcast. And we're talking thousands and thousands, like tens of thousands per episode. And that's why it never stopped, And now 4 years later, episode 50.
Here we go.
It's crazy.
God. Whose idea was it? I can't remember. Your idea, right?
I came to you because I was on your SPI show.
That's right.
And I always enjoyed that podcast. It was the one that had the guests on it. You weren't just pushing your own agenda. So
I don't have an agenda.
it was your agenda
I
was
say
just
with a royal smirk for those people who can't
you make
see
money
me.
off buyer's agents. That's your agenda.
Yeah, God.
The media man for buyer's agents. But all jokes aside, your podcast resonated with me when I was first investing. And then when I started to become more successful in my own right, it was almost like a bit of an intro to other investors, what they're doing. And it was so resi focused. Like you had residential covered by every different angle, from the blue chip guys to the developers to the ones that bought the house and land package. Well, you never went down that route really, but you talked about why you wouldn't go down that route in some cases, but commercial was just the forgotten part of the economy. And that wasn't just your podcast. There were no other podcasts out there. And that's what I really struggled when I was investing in commercial, because I had some really big wins. Like I bought my first commercial in 2015. We launched this in 2020. So I had 5 years of personal commercial experience before I even listened to a podcast on it. And it was really hard not having anything to listen to. There were no real good books. There was a couple of things in the US which was just totally not related to what we do. And it was just to give back, let people know what I saw in commercial. And by then I had a lot of experience in it. Like we'd done probably 1,000 odd deals at the time, and I was making more equity and growth out of my commercials than my resis. I just wanted to tell people that a lot of the stuff you hear about commercial is a myth. And that was sort of the initial breakdown the myths.
Yeah, it's what we did initially. And I sort of think back, 4 years is a long time. It's not long at all. But it sounds like something I'd say, go, stuff it, let's just do it, right? 90% of winning is beginning, right?
Yeah.
And what is it? Imperfect action always trumps perfect inaction. So we pretty much embrace that, no doubt, like a lot of our listeners do when it comes to commercial property. You're never going to time the market perfectly. But if you get started, you probably got down the right pathway. But 50 episodes is a long time. And we haven't run out of topics yet.
No, look, we can keep going on forever because it's always changing. And it was funny, just before, we'll get into this later into the podcast, but listening, I just sort of went back to a couple of those first podcasts we ever did, just hearing, hopefully we got it right. Like we were talking about, I was very pro-industrial back then, very, even office, I said, like suburban office is good. I was never really into the CBD stuff. And that was more like, not because of COVID or any of that. It was more to do with off the plan resi apartments. Like I'd always prefer the house in the suburbs over a 30-story building, and that mindset was very similar to commercial. And it's funny how it's all the same. Nothing's really changed except the interest rate. That's
That's
basically
the only
it.
thing, because I was going to
Yeah.
ask you what's really changing for you. And
So the yields are similar.
yeah,
Rents have gone through the roof since then, so they've kind of made up for some of the interest rate. But yeah, look, basically, the price per square meters are higher for everything, including office, and cash flow is higher. But then you've got a much higher interest rate. So I'll quote some numbers from like July, August 2020. We were seeing an average rate of about 3.5% for clients. And I remember I secured a loan on my own property. I got 1.9% through CBA. I remember like this was a 10 mil asset. That one purchase gave me after mortgage 420 grand cash flow positive.
that's crazy.
So I was like, why would you
You
not?
still got that?
Still got it,
Is it still positive?
100%. But no.
No,
I
no.
actually put it
That's
in.
good dough, right? Like,
Yeah, it's hard. Like I'm probably around 200, 250 plus
Yeah.
on that now. So because the rents have gone up, but yeah, the mortgage is horrible compared to what it was. But even then, it was like money cannot stay that cheap. Like 1.9%. If it stayed that long, what would happen? Everyone would just load up, and there'd be a bubble. Like imagine like the housing market if you're getting loans like that. Like the fact it's still growing even when interest rates are triple, then it's frightening what would happen if rates went back down to what they were.
So the market's changed and the economics have changed, and the economics of borrowing has certainly changed. But largely, it's very similar. The objectives of people are still the same, i.e., I want to create wealth through investing in commercial property, hopefully with positive cash flow. The strategy is largely the same.
Yep.
You buy well-placed, well-positioned assets with good yields and hold on for as long as you can. But tactically, it's probably a little bit different.
Yeah, there is not that free ride where I used to say there was a differential between the cap rates and where the interest rates were. Like that was one of the topics in the first book I wrote. Okay, that gap where you're getting 4% better than the interest rate that had to close. Like historically, it had to close. So if you looked at that one metric, that was kind of a giveaway the market was going to go off its head, and it did. Like those people in COVID that held their properties through March and April, because most crashed, because why wouldn't you? We saw all these, people dying in the streets, whether or not that was true or not, that's another story, but in Beijing, and then you see, remember those Northern Italy stories that were coming out? Like it was frightening stuff. And then you're buying a commercial property in the middle of that? Like madness. But those who held onto those properties got really good discounts. We're talking 20, 30% they made 12 months later. But the best bit is we negotiated all these crazy things like rental guarantees on leases. So let's say you had a 5-year lease to an industrial logistics business. We were so fearful of the market. We went to the vendors. The only way we're proceeding with that is if we get you to guarantee with legal paperwork associated to back that lease yourself. So the old owner became the guarantors of the lease. So it's like a double-backed guarantored lease. And you think back now, like
It's innovation, right? In action.
It was the only way to get a deal through.
Yeah.
And like we wanted to protect our clients. So I'm thinking if the owner sells, he's got a lot of cash in the bank. We need to at least have that protecting the client, because who knows what COVID's going to do.
God. Well, if I was going to score us thinking back then, I haven't listened to any podcasts, but what I do remember is I think the intent was right, and the intent remains the same, to help Australians be better educated around being successful in commercial property. I think that's pretty consistent. I think we've always had a steady hand when it comes to it all. Even when you're getting a lot of sensationalist commentary coming through, we were like, just take it easy, everyone. The voice of reason and sensibility, I think. And I think we've been well regarded for that. And I think we have a very loyal listenership as a result of that. I actually helped steer people through what would have been dark times for some people. And for those people that took action during that point in time, I think they've done very well. And also the insights or the aptitude to embrace this idea of counter-cyclical investing, right? Like, investing when other people are fearful, if you're well prepared and well geared and well regarded. So I score us pretty well. We'll have to listen back one day, maybe over a couple of whiskies, and
Yeah.
hear us mumble through those first few podcasts. You reckon Rethink's changed much in that time?
Oh, look, fundamentally, no. There's
Mm.
just more people. So if anything, we've got a little bit more corporate because I guess there's just, management layers now. But the investment strategy, 100% the same. We're very strict on our yield still. Like even when the rates were like down in those 2%, we felt like you'd go down to 5.5% net yields, those types of things. And it's interesting, like a little controversial thing I'd say is like there's been a lot of copycat businesses that have come out since over the last few years, and we've cornered the market in certain areas, like to the point where there's one area where we'll have 6 to 7 of our own agents see the property before it hits the market. So they all get, they're all on the sort of, and they compete internally. And then if they all reject it, then it'll go to the market. And even on the market, we might have another crack if we can negotiate harder. But then we see those properties get bought by mostly just external random buyers. So I'd say 95% of what we don't buy is just an individual buying. But then you see the odd buyer's agent pop up, and then they bought it at 5% net yields. And we were like minimum 6% for that. So that's a 20% difference in price. So one thing that we've kind of been able to do in the areas, and this is a particular probably sub $2 million comment because there's not enough stock. And the only way the others get in is just by buying them at sharper yields. And it's funny, I've heard them on other podcasts justifying why they go sharper yields, and it'll be, oh, look, it's a secure property, all that kind of stuff. And or you're putting a big cash amount down, but that doesn't change the fact that in that same market, you could have bought that asset at a 6% if you negotiated well. You've just met the market. You paid too much to either please the vendor. Like you've got to let them go. So I think you've got to remember why people come to commercial. It's for cash flow, and that's really what Rethink, has always been founded on. We want good yields, and sure, we will go sub 6% for the right deal, but it's very rare. Others in the market, that's their standard purchasing is that lower yielding. So we pride ourselves on not taking extra risk, but making sure we get the yield very close to that minimum amount, because that's how we know there's going to be upside in the valuations. You're going to be protected against these higher interest rates, because you don't want to be going and buy a 3-4% net yielding asset. May as well stay in resi, just deal it through that.
Well, but the positive cash flow is a nice attraction to commercial property. And I think by creating this podcast with all those points you just mentioned, you've largely created a whole new generation of commercial investors who may have eventually found commercial property, but no doubt you've probably accelerated a lot of people's journey through property and resi property into pivoting to the commercial a lot sooner as a result of this podcast. And, you should be quite happy about that.
Yeah, look, officially we're just coming up to our 4,000th client purchase. So I think we're like 3,970, something like that. So, and that's growing at about sort of 40 per month. So we're going to hit 4,000, probably July this year. And that's a big proportion in this very niche market. So this is the thing to remember. Like, this is not resi. Resi is 50 times the size, so 50 times more competitors, 50 times more stock. Like, it's a lot more free flowing. And commercial's the forgotten, cousin that no one talks to.
But the problem is, though, if we've told too many people about it now and made it harder for yourself, right? Like, it's created this cohort of people who are now looking to create wealth through commercial property. But the more people in there means that there's probably less good deals around, right? Or it's more competitive to find those deals. So you and your team will need to work a lot harder to make sure you get the deals before other people, so you can grab that. And you maybe shared some stat with me sometime. What percentage of commercial property you think you guys transact via Rethink under a certain amount? It's quite a significant number.
Yeah, we're sort of around 19% of the total share of online properties in Australia. So, that's about 400 to 500 properties per year. And, so we're talking 2,000 plus. So we're 19% of the total volume on the market. So it's a large portion. But my biggest takeaway is not that we're a large company, because we're not. Like, we're micro compared to the big big
Yeah.
funds and all that
You're
kind of
just
stuff.
a couple of people trying to get by
Yeah.
running a small business.
It's small business,
Yeah.
but how small is the market?
Yeah.
This is the reason there's no big marketing companies there. It's like, besides Real Commercial and the other commercialrealestate.com, there's really no mainstream commercial companies outside the global brands like your Colliers, CBRE, and
Yeah,
that.
and they're buying different assets, right?
Exactly.
You know,
Yeah.
eventually you might start trading in multi-million, if not billion-dollar commercial transactions. Who knows?
Who knows?
Who knows?
Yeah.
Who knows where everything goes? And
Yeah.
we might still be doing that podcast at that point. Who knows as
Yeah,
well?
we'll see.
Maybe we'll run out. But your team shared with me a stat that since the start of the podcast, you've completed sort of $3 to $4 billion in property transactions since that point in time.
Yeah.
Pretty cool.
And it's funny how you still learn. Even yet, the one thing that happens is you get a little bit less tolerant when things don't go your right way. Because I'm on the coalface negotiating, and it's funny.
People think that you probably just sit there with your feet up on a desk, probably smoking a cigar, but you're still doing deals.
Yeah, you love it. It's fishing. It's part of the game. You do it as it's a hobby. The things I love is building a business and a brand, because it's part of life. You just want to move forward.
Yeah.
It's really not about trying to, I like increasing headcount, brand awareness, revenue, all that comes part of it, but you don't literally count the revenue because you're not spending it to a point where, you've got to put that much into marketing and I've got to put that much in my personal account. It's got nothing to do with that. It's just the thought of moving forward as a business. And we've helped so many people, thousands of people. And it's been an absolute pleasure working with these guys. And to the point where there's probably about 15 of them working for us as well. So, you end up hiring them and working together. And we're a very sort of let you do your own thing organization as well. So, because these guys are, and girls are very successful in their own right. And
let them run.
Let them run.
Let them run.
And that's what helps build the company, and we help more people as a result.
No, that's good. Well, keep up the good work. And I remember the first episode we did was residential versus commercial, the big debate. And we should listen. I might tune into it next time I'm doing a bit of a drive just to see how we went with it all. But this debate, you reckon it's changed much in 4 years?
Yes.
Resi versus commercial? It has changed.
I think so.
Okay.
Well, remember, no one thought commercial grew. That's the big one. We've debunked that myth, and even the media has. You got the the famous Western Sydney industrial stories that it's grown 60% in 2 years, and they've seen what COVID did. All those people that bought neighborhood shopping centers and they doubled in 5-10 years. We know these things grow. They're worth tens of millions, sometimes 100 million plus for a big deal. How's it not grow? And that was how basic things were. And I'm dealing with this in New Zealand, by the way, as well, because they think
we spoke about that recently.
Doesn't grow. And it's why is that?
Well, last time I got together with you showed me some numbers that pretty much said commercial was growing at the same speed, if not a little bit higher than some resi markets.
Yeah. So, and we've commissioned another study, and just to recap what that means is we have some sources, it's the highest level of RP data and a couple of other those data collection agencies, and you've got to spend tens of thousands to get it. But we then pay people to go through the granular data. So looking at, say, secondary industrial, Perth metro, middle ring suburbs, and you've got to get the thousands of little sale prices from the 90s out of there. And then you've got to look at the photo and make sure it looks at a similar age. And then you compare when it was next sold. And then it's basically just lots of touch points. It's really manual. That's how you get.
Can't you get a machine to do that these days?
Probably.
Everyone talks about AI, but still not that smart. You still need someone contextually to actually look at it and actually go, oh, yeah, well, technology can only help so far. But I reckon we've learnt a lot over the 50 episodes of Inside Commercial Property around this resi versus commercial, probably debunked quite a few myths around it, and hopefully accelerate people's buying decision to leverage out of resi maybe earlier into commercial.
Yeah.
And we should probably share some of those discussions. But there's this, undertone of ethics in real estate, undertone of, what is appropriate, what is right, considering some of the social considerations. in and around resi properties, affordability of homes, increasing rents on people when they can't afford it. The market dictates and determines it in resi property. What's your sort of lens towards the ethics in resi investing versus commercial investing? Because in commercial, pretty much, if you rent the space, you've got to pay for everything connected with it, which is one of the great aspects of commercial property. And typically means that your property is more affordable to hold, and potentially the likelihood of commercial property being positively geared over resi is the propensity of that's a lot higher. Structurally. That's a good thing. But do you sleep well at night knowing that poor resi investors, poor resi tenants are struggling through all these interest rate hikes and the flow on of mortgage debt to them?
From a couple of different angles. So it's interesting you mentioned like the ethics side of things, because over the years I've been in those clickbait articles, like investors 0 to 12 mil or whatever it was, the first one. And the first one was the worst because I think we were obviously young at the time, and it was like, I can't remember, it was a news.com article.
Haters come out.
Oh, it went viral. It was the most read story of the day. Millions of people saw it. It was translated into 12 different languages. And we opened our Facebooks, my wife and I, like how there's a section in Facebook where if you don't know the people, it's like a message request.
Okay.
There's about 100 plus of these things and 90% of them were there was a death threat in there. People like, you were reason we can't afford houses in Australia, you're absolute scumbags if I ever see you, all that kind of stuff. It was full on. The wife got completely attacked for being blonde or young, whatever, they're saying gold digger, all the wrong reasons, the typical let's just have a go at a woman type of thing. That's what they were doing. And they had cracks at me any way they could as well. And it was because we were, I think, young, more relatable back then as well, and it was all resi. Once we started moving into once the articles switched to commercial,
no one cared.
No one gave a crap. Maybe we were a bit older. The portfolio was less relatable. I think you're in. You studied media. There's a point where you just don't care. You see the billionaires list. Who cares about that?
Become
random old guy who's got 4 billion. Who is it? I can't relate to it. But someone who's similar to your level, maybe a bit younger and just got ahead through, let's say, and the feedback was, you're not creating anything for the economy. You haven't built a business, you haven't hired people, you've just speculated. And it's true, but we're using the tools that this great country has given us. You can leverage safely into a property. We had good jobs, and anyone that should try, it's the way of getting out of the middle class. That's what property was. And those who are still in there can resent you for it. And so from an ethics point of view, that's one of the things they targeted, these greedy landlords pushing the rents up and all that kind of stuff. But I'm a big believer that you're just part of the economy. What you do is what anyone else would do. And, never charge a tenant above market rent.
No.
And you will reward tenants who pay on time, because I've had plenty of tenants that, might pay top. My highest value tenants are the most painful, you're never going to give them a reprieve. But if you've got one of your more affordable ones and they've been there for 5 years, of course you're not going to redline them, I don't think so. But ethically, it's been an interesting journey. But the older we got and the more commercial we went, the less people cared.
You're just running a business, but this is what a lot of people don't really understand and appreciate if you're outside of property investment at a residential area, is that you're in business, you provide rental accommodation. You're a rental accommodation business if you invest in residential property. That's what you do. You're in business, right?
And we pay, the amount of tax I've paid over the years would have been.
Yeah, I'm sure you've contributed. Yeah.
And now payroll tax and, all that stuff.
Well, I saw New South Wales now has changed its tax rules. They're not indexing the growth in real estate on land tax now.
Oh, really?
No, it's fixed now at $1,039 or something like that. So they're now saying it's not going to go up in line with the value of land. So that means already, I think, this will affect property investors.
I know you sort of follow the fringe suburbs of Sydney, like those holiday home areas. There's very little activity in them. They're all selling. Remember when everyone bought a holiday home in COVID?
Yeah.
And now the mortgage tripled on them, and now their land tax is hitting them. That's going to be a bit of a a long term. We're getting sidetracked it here, but it's really interesting to see how bad some residential investments have become because of the cost of holding, and we're seeing it in Victoria with the land tax threshold going to $50,000. So everyone now pays thousands of dollars more in land tax. So yeah, it's going to be interesting for those who've got lots of those properties. That you got to make sure you can cover your
Yeah,
bases.
you do. Yeah, and this property investment, it's pretty good. There you go, from memory for those people watching it. The freezing of the threshold is 1.075 million. That's unimproved land value. And the New South Wales government estimates that 30,000 properties will be affected immediately by this. That's 30,000 people now who fall out of this land tax free threshold who are going to have to start paying land tax.
So you watch more supply in those markets come on.
Potentially, it's going to disincentivise property investors, and these are for people who hold property outside of their personal names and are above the threshold. So, and this is this debate around sort of resi versus commercial. The biggest difference, going back to the sort of ethics, just to conclude that point, is that one of the criticisms Australia gets, mainly from America, is this tall poppy syndrome type of thing, where in America, if you do it in America, you'd be like guys and girls high-fiving you in the street going, yeah, man, you do it, You know what I mean? Like you'd be the guy getting the bottle service at the fancy bars, right? Like, and people would think, I want to be that person. Whereas in Australia, there's still this inherent, you put your head above the parapet for being successful, you be taken down. And that's why podcasts like this are important, because we have a friendly audience. Everyone tuning into this. There may be some haters in there. But people aren't going to invest hours and hours and hours and hours and hours in time to get riled up about people making money through property. So these are the communities where you can actually highlight and showcase how you can create a sustainable way to create wealth through property that people can emulate. That's why we do it. And, we'll go and tune into episode 1 of Inside Commercial Property at some point. But it's challenging. And there's a lot of Aussie business going bankrupt at the moment. Is that it's probably more than what it was through COVID, but during COVID is where the big scare was, and this is why counter-cyclical investing, don't invest in commercial property, because all these businesses are going to go bankrupt because they can't trade and operate, but the government come in and saved it through JobKeeper and JobSaver and all those other incentives around it. So, which some people say caused too much cash and inflation bubbles and all this sort of stuff. We're still dealing with it, but things have changed a little bit, but it's largely all the same.
Yeah, well, I was looking back. Again, one of the things one of the guys on the team pulled up from an early podcast. So I think this was the first one we did on 12th of June. The market update. Someone was like, what can you get for 500 grand? Like, and we used to talk about like 300 grand assets back then. Like, they're gone, And if you're buying a 300,
we were talking about $300,000 commercial assets
because we were buying a few at the time.
God.
Yeah, like we got
like
down
a
to one
car park or somewhere or other.
No, these was like
A little
100 square meter, like decent warehouses up in Brisbane, and they were definitely out there. But I remember like reading the notes here. So under 500 grand, this was the market update in 2020, and this is during COVID. Under 500 grand was super tight. $1 to $2 million, it starts to get tighter, but people are slower to make decisions. And the returns that you were getting was sort of around that 6 to 7%. Exactly the same. All of that. We're talking 6 to 7%. The only difference is 1 to 2 million's like very tight now. So
there's not many good deals around, or they get snapped up really quickly, or
there's more depth to the buyers now.
Yeah.
It's just more of a mature market. Like there's more awareness. Like you said, we've been part of this wave of new investors come into it. We're the investors that got in, after the GFC. There's probably heaps of people doing it before then, but this next generation, the GFC was reset for you can almost tell from all the residential buyers agents, there's very few that go pre-GFC. And that's typical of every crash and boom and bust. That once you bust, a lot of new businesses are created. So that's why a huge amount of the funds, you can see their inception date was 2009, 2010, 2011. It's very typical. If there's another crash, you'll find all these new businesses come out of, the rubble and start from that low point, because it's actually the best time, because you're getting in at the low point. Then basically the tide comes in. So if you've got a good product and a good service, it will generally be the best time to start, rather than start at the peak, which is what you'll see a lot of other do pre-GFC. They'll fall foul for the other direction of the market.
I always find, and I look back at the stuff that I've done in business, you're best off doing new things when times are tough. And I personally like operating in that environment. I sort of don't really like it when it's easy. I like it when it's hard, because it prompts and encourages a different way of thinking and reacting and innovation. Like to you putting these guarantees on leases at a point in time and of the traditional owner of it, like that's all smart business. And you've got to be attuned and you've got to be aware of when times are tough and buck the trend, right? And you see it post GFC. You saw it when we launched this in the depths of COVID and coming out of the back of it. From there, you've had a lot of lookalike businesses emerge as a result of the COVID pandemic, both in resi and commercial property buying. But ask a lot of them how many properties or the value of their property or how they're buying, and there's a lot of buyers agents out there today that don't have any properties, right? They don't believe in the asset class, but they believe in providing a service. Whereas you very much put your money where your mouth is. In episode 20, we did the podcast was managing a multi-million-dollar portfolio, and we spoke about your portfolio, the pros and cons of it. And I've spoken to you about this a fair bit, and your wife Nina. We did a really good podcast chatting through the relaunch of your book when you did the next run of it, and you've grown a pretty big portfolio pretty rapidly. I think you've had time on your side. You've been in the market longer than most, but there's still been a lot of people. There's generational wealth in commercial property tied up for 2, 3, 4 generations in Australia. You just need to go around, and all those boats on the harbour, like that's not normally new money.
No,
that's lots of commercial property for a long period of time. But you've grown your portfolios in that point in time. I think you had a valuation sort of about 46, 47 million bucks. It's probably grown a lot from there. But time has been probably the greatest friend to your growth in your portfolio, I would imagine, as well as some shrewd and smart investing.
Yeah, well, like I said in a previous podcast with you, like none of this is rocket science. Like, so the reason I've been able to get to that level, one, it's been a brilliant bull market. Like I bought my first property in 2010. So what are we, 14, 15 years in. So, basically everything is doubled or tripled in that time. I took more actions than most, like literally every time I could buy, we were buying. So those investors that have done the best, all the ones you interview, it's the ones that make the most moves. If you're, buying and buying and buying, and you know what you're doing, you're going to basically leverage your position and it'll become a better situation. But yeah, the compounding nature of property is really the true gain. And we're up to sort of, 85, 90 mil in property. And the average growth rate of commercial for the last 30 years has been about 6%. So 6% on 90 mil. Now, call it 5, 6 mil growth you're going to get every year just from an average market.
It's crazy, isn't it?
And that's literally why, why I'm now passive, because there's no point just going, I'm going to quickly go buy 3 more properties. I'm definitely going to keep buying because it's kind of like something to do.
Enjoy
and
doing it.
Yeah, but I'm buying different types of things, like where it might be, maybe an office or, just silly purchases, things like that. But yeah, like it's not, there's no, like I don't have investors that I need to report returns to or anything like that. So it's just make sure you cover the position, the liabilities. But once you get to a large portfolio, and we've got so many clients like that have $20+ million portfolios. One of my clients has a $300 million portfolio. And I look at him and go, what do you do with it all? There's just, and he's got, I think 250+ tenants, commercial too. Like
that's a big business running that, managing that. You need your own asset managers, right?
But he loves it. This guy gets involved in every lease and writes the leases. Like he's kind of a little bit
okay. Is this
peculiar
all he does?
in that way?
That's all he does? Is
that's
his business?
Yeah,
right?
he's got all the usual hobbies that wealthy people do, and but
you go to a lot of lunches and drink a lot of wine and eat a lot of steak, and you got to be careful of that as well, right? Like you can't do that every day.
No, they network a lot, and it's kind of like just meeting interesting people. I see a lot of those the most wealthy clients do. Most of them have a plane or a random holiday house somewhere, a bit like
Yeah.
got holiday. You don't have the plane yet, but
Holiday homes all over the joint.
all but it's their lifestyle. So they go and tinker with their properties, and then they don't take any action for 6 months, and they go, oh look, I've got all this equity, may as well buy a shopping centre, that, and then it's just a game to them.
How many tenants do you manage? How many tenants inside of your portfolio?
I think the last count's about 68.
Okay.
And we're going through some like really interesting hardcore things. Like, for example, we've just had our like a Chemist Warehouse move out.
Yeah, you mentioned. Yeah.
And we're looking to get our supermarket and the bottle and they want the space. So it's like, all right, we've got to negotiate who gets what portion of that. Do they move out of their existing space? Like, what's the square meter rates? Like, so the first thing I did is went to one of my trusted valuers and said, show me your market evidence, because I've got our own data through Rethink, but just wanted to get a valuer there because I know they're going to try and negotiate. So if you've got valuer data, it's like, well, here you go. Yeah. This is a third party. It's not just me telling you. So I enjoy that part of it. Really don't enjoy dealing with the maintenance and even the capital work side of things. Like, it's generally not, I'm building a beautiful new thing. It's repairing a roof or
once you do it once or twice and you learn about it, you just go, I don't want to deal with it. Yeah. But that said, you've got to do it so you can actually look at a quote.
Yeah.
It gets to a point where you can look at a quote and go, nah.
Yeah.
You're getting robbed.
And people are always trying to take advantage of us. Like, it's just the nature. Like, I think they look you up and go, he's, runs a business. Yeah, I'll triple charge him. But, and that bothers me because I've been poor way longer than I've had money to be, and it's all relative, like but it's, you don't like getting ripped off, and property
it's the biggest thing. It's one thing. It's like, no.
And especially as an interstate property investor, you are the biggest target ever to get screwed over in terms of bills getting passed on to you that shouldn't, or the standard, let's just quote them double because they're probably not even going to see the bill because their property manager will just pay it. And it takes a lot of effort and very granular to go through that. It's like going through a P&L on your report and check, why your internet bill's higher. Like, you've got to do it. You've got to do it at some point. You've got to get
become a lot more
to
tuned to it. But it can get quite fatiguing. However, that's the name of the game, right? Like, investing in commercial property is not glamorous by any means. It's nuts and bolts, and it's sometimes dirty and annoying and confusing, and sometimes you can't.
And that's a good point you bring up. One thing that has changed is it's less glamorous than what I thought back in 2020. Because like by then, it was, I guess we hadn't hit the COVID period. Like, there was the zombie business period where there was a lot of people getting propped up by JobKeeper. There was, we're going through a high inflation, high interest rate environment. That's not good for a small business. So just finding vacancies sit a bit longer. There's headwinds here, and we need those headwinds, by the way, because that will lead to an eventual interest rate drop. So that's a less glamorous side, but there's like, an example of a poor story that I had was we had a real estate agent as one of our tenants.
I was going to ask about this because we've covered some pretty controversial topics over 4 years, and real estate agents have certainly been, and we're friends with all property professionals, obviously, but we'll call it out where we call it out. Yeah. Most real estate agents are good operators.
They are. But like, I had one as a tenant. They know the rules. So they signed a 5-year lease, and then they basically stopped paying, found some silly excuse like, not enough car parks, or the air, the electricity bill's too high. I can't even remember. They just broke their lease and basically said they were bankrupt. And then next minute you see them renting the other side of town. This is a branded business. I'm not going to name who they are.
No. That's when we find ourselves in trouble.
Yes. So, it's like, and they just basically walked away from a 5-year lease. And the advice from the lawyers, because I want to, especially because of who they are, I want to go them. I want to make sure they pay what they're owed out of principal.
I bet you the lawyers said, cop it, don't worry about it, move on, get someone else in there.
No,
it's not worth
this is the best bit. So they said, just wait, fill it, make sure you quantify your exact loss, and then we'll go.
Then go for damages.
And that's something over the years
because you can actually prove the damages then.
Yeah, and you've walked away from a lease. You're not bankrupt. You're collecting rent and money from. You're doing well. But they just had a change of heart with that location, or maybe got a better deal somewhere else, and they think just an easy thing to walk away. But a commercial lease follows you, and that's very different from residential. And this is another big difference, which I think residential investors are going to get increasingly frustrated, especially the large scale ones. It's very hard to deal with the fact you can't evict tenants or bump the rents up as fast as you need to. You're forever behind the eight ball from a market point of view. Like the tenants win, and that's all fine. We're here to provide them shelter and that, but like you're investing, and generally it's a middle class person, I'm generalizing here, investing their life savings into a property. They need a return in order for them to have a chance of being self-sufficient in retirement. If there's government putting handbrakes on everything at every angle, you will not retire, and you will sell that thing. And this is what's happening in Victoria at the moment. Invest, and people go, oh, poor Crimea River, poor investors, but they're selling up. There's less rentals, and these aren't super rich people, but they're rich enough to be, tall poppy syndrome, I guess. It's
Yeah.
like, don't worry about them. And a lot of the Labor governments around the country, it's an easy target. They're using it to effectively pay back debts, and we saw it in Queensland. It nearly popped up. They backed out of it, and the land tax rules. But yeah, it's just, I don't like that from an investing point of view, because the older you get, the less tolerant you're going to get, and the less moving parts you want in life. If you've got a big
And the less
residential
time that
portfolio,
you have as well, right? And
Yeah.
the point being, and controversial topic we covered on this podcast and other podcasts is if you keep changing the rules, it makes it hard for people to plan and prepare for retirement. So you're contributing to government coffers rather than taking from it by way of a pension.
Yep.
Wouldn't you be doing, if you're in government, everything you possibly can to make sure there's more self-funded retirees? Like,
Yeah. It's the votes.
It's a
Like
no-brainer.
and this is the thing. As more people get priced out of the market, this is one of my big grand predictions, which I think will eventuate. Is over time the market will keep getting more expensive. We've seen it, and it's going to then put it out of reach for more and more people. What does that mean? Less homeowners, and as the percentage of the have-nots with property get larger, that's the voter base that they'll try please. So the minority of those owners that are in the property market, they're going to get targeted, and then they'll change rules. Negative gearing might be one of them. Land taxes could go up. They might cap the amount of properties or the debt levels. That, like, you've seen what they've done in New Zealand. With over there, that previous government smashed the market, and it caused about 20% fall in price when Australia was growing. So
Yeah,
you just got to be careful what happens, because governments control your destiny sometimes.
They do, and hence the reason why it comes down to really smart asset selection, that irrespective of what the government chooses to do, it's not going to impact initially and primarily your ability to hold a property. Yes, there may be different consequences at the back end when you try and realise the wealth that you've created in it, and that they're always going to change the rules in some regards, and property investment is a nice safe bet, but it's an uncomfortable truth, talking about sort of controversial topics, and we've covered this beforehand, an uncomfortable truth for Australia that they're going to have to accept what you've just painted, and that is home ownership and the way property works in Australia moving forward. It's going to be very different to how it has been up until this point in time. This dream of the great Australian dream of a quarter-acre block in the suburbs with a picket fence, that is still available and accessible. It might not just be 5 kilometres from the Sydney CBD or the Melbourne CBD. So I think the opportunity for Australia is to accept that things have changed and move with the times. We have a growing population. They're not all going to want to live in houses. A lot of them are going to want to live in high-density dwellings. Things are going to change, and that's okay. But if you're going to be investing in real estate, whether it's commercial or resi, just accept that the government's going to change the rules.
I think the key is just don't go too heavy into one thing. And that's, the older I get and the more being in this investment game, and like I'm learning about different countries now, that I think that's gives you a window of what the possibilities are. You just can't be too sure that what you're doing is the right way in 20 years' time.
Yeah.
So, and that's the reason why I haven't gone out and bought another $20, $30 million of property. Like, my LVR is very low. We're sitting at probably 30-odd%. Could go out and quickly acquire a lot more property, but I'm at a level now where I hold great risk, tens of millions in debt. What happens if the banks change policies with loans, or what happens if they scrap negative gearing, or what happens if prices fall 20% and they trigger value. Like, you just got to think. But
Yeah.
I plan for that, and that I know I can hold these
You got to hold it,
properties
and the
through
sort of
periods.
tax policies and financial incentives always going to change with commercial property. And you only need to think back to this generational wealth held inside commercial real estate. So many things have changed over the years, but those families that are now second, if not third or fourth generation commercial property owners, like,
Yeah.
they've done okay, right? Irrespective of how things are, there's been many different rules, many different regulations, many different governments, many different people tinkering and changing things. But fundamentally, they've bought good real estate at the right point in time and have held on it for a long time. That's commercial investment for you. Now, you've got issues, and we've spoken about it on this podcast around, foreign investment and, commercial property driving it, which is increasing prices. Again, it comes down to an ethics thing, but also what is the picture for Australia? And I think what we need on this podcast, Scott, and it's something for us to work on, is we need a really good demographer to come in and talk to us about what's going on. What is the shape? What is the view for property, resi and commercial for Australia into the future? Because it's not what it has been.
No.
I'd like to know about it.
No, and it is changing, and it's changing for young people the most, and then obviously there's the transfer of wealth from the baby boomers. That'll be the other big trend. But now we've got some really good guests coming up in the next few episodes. It's all basically scheduled in, so so it won't be just us yakking. There'll be some new brains trust in there, and
and we get a lot more detail. We have now people wanting to know more about syndicated investments and investing in super funds and all the rules around capital gains tax and what is a comfortable LVR and leaseback and lending capabilities and valuations and stuff. Like, it's all there, and it's going to give us podcast topics till the cows come home. But one thing that you have done over the last 4 years is that you created an education platform. I think this podcast might have been a catalyst for driving that forward. And I'm told we have an advert around it. So we're going to go to it right now. Stay with us, back in a moment. Welcome back, Phil Tarrant, Scott O'Neill, 50th episode of Inside Commercial Property. Do you reckon if we get to 100 episodes, I'm sure we will, can't see why we wouldn't, will much be different? Or it's going to be all the same stuff?
Another 4 years.
Another 4 years.
Take us.
Yeah.
What will happen in 4 years?
Well, in 4 years' time, you would have had 4 years of compounding capital growth at 6% of your portfolio. What's that number? I'm sure you've already worked it out.
Do you know, I used to follow that so, like, to the month, where I'd play these little games. Like, this is when I was in my old engineering job.
Yeah.
Because it was like a window to heaven. Like, you just look at what could get you out of this situation, and like, you could see it on the spreadsheet.
Yeah.
It was compounding interest, and you'd plug the variables in and play around with the future rent values and what cap rates could be at the time, and use long-term average interest rates and assume future purchases. Like, went deep, and it was I could see it was always going to happen. Assume future purchases. Like, went deep, and it was I could see it was always going to happen. The age was about 42. That's when I thought I was going to get out. So it happened quicker, and the reason it happened quicker was the growth was a lot more sudden at the time, and we bought some big value add deals early on that just freed up more deposits that weren't in that spreadsheet, and then obviously starting a business created more liquidity, and that sort of, I always say that the first 20, 30 mil was on me, and the rest has been helped by the business. So not saying this is all capital gains. Like, we're putting money back into the portfolio, we're paying it off. And that's the beauty of investing on the side through a business as well.
Yeah, and it's all about liquidity, right, and access to capital. If you can manufacture it through business interest, put in property, it's smart. We've had some good feedback over the years, Scott, which we haven't really shared. We don't like to sort of toot our own horn. Is that the right saying? Or we're conscious of tall poppy. We do it because it's the right thing to do. But I have some feedback here, and I'll just run through a couple of points because we asked them what they thought about inside commercial property. Chartable. Is Chartable? Is it Chartable? Is that a name? Chartable? No.
I think it's a podcast.
It's a podcast reviewing thing. Yeah.
Platform.
Okay. So it's okay. I don't even know about that.
Chartable.
I might go and check it out. See if there's much hate mail on me. But transparency and value. Rethink Investing are an incredible company and always put their clients' best interests first. They are honest, transparent, and genuine in all their dealings. Highly recommended. Engaging with the best in the business. That's cool.
Did you write that?
No, I didn't write that,
Oh,
but I have one here. Erudite and handsome. Philip Tarrant carries his podcast. Without Phil Tarrant, Scott O'Neill's business. No. There's another one here. It's just from Apple Podcasts, HPJPR. Educational content. Latest episode with the accountant was great. Thanks heaps, guys. I've learned a lot from it.
We've got to get another accountant on, actually.
We do.
That'd be another one for the next 6
Mine's
months.
calling me right now.
Oh.
There you go. He must know.
It's a bit creepy, isn't it?
It is really creepy. It's actually calling me right now.
Trying to get the gig again.
No, he's probably he's chasing me on some numbers he needs. Down-to-earth discussions. This on Apple Podcasts. Edward TB. Thank you, Edward. The hosts give real-life examples in a mix of demographics and explain the fundamentals of commercial investing in an easy-to-understand manner. That sounds like a report card. I'd say that's a good 9 out of 10. Global relevance. Here we go. Listening over in the UK. You must have a lot of expat clients trying to get their dough back here. And
You see it on Chartable, actually.
yeah,
So Dubai, UK, New Zealand, they're the most listened to outside of Australia.
outside of Australia. And I
randomly.
imagine the Yanks, the Aussies in America probably.
They don't.
don't
We're
care.
just a speck to them.
Listen over the UK, but so much of the excellent content is relevant here. Thank you for sharing and g'day. And Jordan Cook, is that right? He's an employee and an avid listener. Is this how people do their training? When they rock up at Rethink, do they go, here's now 50 episodes, listen to them. There's your first week.
That's your homework.
That's your homework. Go and do it. And it's probably not a bad resource, to be fair.
No, he's actually buying his commercial property at the moment.
Oh, is he?
too. Yeah.
Oh,
So
very
he's
cool.
his client and he works with us.
No, very
Good guy.
Enjoyed listening to Scott and Mina's personal journey, scale back. That's all really cool stuff. People are just finding this. What's the best way for them to tune in the podcast? Just on all the Instagrams and
Yeah. So, and one thing we wanted to ask as well, because we never really do request this, is if you're listening to it on YouTube or Instagram or see it on one of the TikTok shorts or something, if you could just like or share, like, let's be honest, people aren't going to go share everything these days, but like just like it. If there's a review section, it really helps the channel get out of the mud. Because like when we first started this, there's probably, I don't know, 50 odd property podcasts. Now there's
about 1,000.
It's literally gone exponential. So, it just keeps us out of the,
Well,
out of the general.
I've got to give myself a plug. Whenever I look at the top charts, this is normally in it as well, but the Smart Property Investment Show.
Well, you built
It's
that big
been doing it,
database
yeah.
early, and that was one of the
Yeah.
keys you've done well. Is like it's the early adopters. You got into the podcast medium before it was a thing that every business had to have.
Yeah.
Now, when they all start, it's like it's an effective tool, but it's almost it's like emails these days.
Yeah, it's like a website, right? But
Yeah.
you've got to make it fresh and interesting and unique, and which I think we've done really well on Inside Commercial Property. And one thing we started semi-recently was your burning questions. I have a couple of them. Let's quickly get through these before we close out. Scott, what's the sweet spot for LVR for commercial property?
30% if you're sub 3 mil, 35% if you're above that. The reason you go more cash down on the bigger deals is the banks will just look after you a bit better. There's a few bank policy restrictions at that level. You can still get an 80% loan. That's something that's changed over the last 4 years. Like back then, we're like, yes, go to ANZ, get your 80% loan, do your lease stock loan as much as you could.
Yeah.
But your interest rate's now 6-7%, not 3%. So you've got
So
to
you could pay a premium of % back then and still make good dough. Now it's
you got to be
a
more
different
prudent with
proposition.
debt. And this is one of the, like you said before, it'll be interesting when there is a turn in the market because those have kind of gone a bit too hard will get found out. But right now, things are still moving in the right direction. Banks aren't going to really apply much pressure. They're in good shape.
Yeah. Okay. Question here: when purchasing commercial property, how important is it to understand CPI increases and tenant scheduling? I imagine you're going to say it's important.
Oh, CPI has changed so much over the years. I remember CPI when I first started, well, even this podcast, but definitely when I started the business, it was like frowned upon. Like, oh, you don't want a dirty CPI, like 1.9% per annum increase, like rubbish. We want the fixed increases, 4%. And then that flipped during obviously we're at higher inflation. Everyone looked at a 3% fixed rate or even 4% fixed rate, and they're disgusted by it. They're like, oh, I want the CPI because I'm going to get 7.8%. And now we're down to, as of today, 3.6%, and it's trending down. And eventually it'll be in the target, one would hope.
Yeah.
So CPI, it's a moment in time. It's like it really just keeps the pace of the rental increases, but at the end of the day, the market will always get brought back. So there's a market review in leases. So even if you had huge CPI increases, if the market didn't keep up with that, if it can't sustain that level, then it's going to come back.
Yeah.
It'll be an inflated rent, or vice versa. It'll be under rented.
Yeah, and it's a moment in time also. If you might need to wear less increase for a period of time, but there's going to be a point of renegotiation where you can calibrate your rent back up to market.
It's just noise. It's a temporary, fix. So I don't really put much emphasis on what it is, as long as it's going up.
Final question: what does 500K deal get you in 2020? 100 to 200 square meter warehouse with a mezzanine, small retail or residential, office, suburban offices? Question mark.
So in 2020, we were doing lots of these deals,
Mm.
and they were generally like a 100 to 200 square meter warehouse. Now it's much harder to find those because the square meter rates have effectively doubled in that time. So rents have gone up incredibly as well. So the yields are kind of still there. We're still looking at 6 to 7%, but you're just getting less floor space. So there has been growth, but there's been a softening in prices since the 13 rate rises we've had. We've had 6 rate holds now as well. So the market's kind of gaining momentum from these holds, by the way, as well. So the assumption is when the rates do go down at one point, then the market will kind of spike again. So we'll see.
So hurry up and get into the market.
If the mortgage doesn't bother you, yes.
If the mortgage doesn't. Okay, well, mate, well done. 50th episode. I remember I looked at the show notes before we come on air. It said it was a special 12-part series.
Yeah.
So we've done a bit more than that.
No, and I wanted to take the opportunity to thank you throughout the, I literally thought we'll do this for 12 episodes, but it's turned into a really good business relationship. It's part of the podcast. The Inside Commercial podcast is consistent, and I think consistency is nice. Like you see a lot of people chop and change, and it'll be interesting how we act when there's the first major recession.
Yeah.
In a weird way, I don't look forward to it from my client's point of view, but from our point of view, it'll be an exciting time to talk through that, because I want the listeners to hear that we're not always positive.
Yeah.
So we won't be when.
Well, the thing is that I reckon we're both glass half full type.
Yeah, we'll see opportunity in it.
Yeah.
But we're not going to be just saying, buy. It'd be like, all right, well, you've got to be very targeted. You need to get 30% off here, or get a certain yield, and then plan to hold through that period.
Tactics change, right?
Yeah.
Tactics change, which I like working through. And to your point, only 11% of podcasts globally make it to their 50th episode, talking about consistency. So, yeah, consistency is key. Consistency is sometimes boring as well, and commercial property, no doubt, investing in commercial property should be largely pretty boring.
Yeah.
Yeah. You might get excited about the outcome, but the process is, I'll leave it to other people, and I'll buy another property coming up as well, so we can talk about that.
Oh, look, Australians are property hungry, and it's an alternative. It's funny how much more educated people are with commercial now. I remember, this is why we don't go over the fundamentals in this podcast. Like, if you want to go 101 commercial stuff, go back to the early 2020 days. It's all there. It's all relevant. It's there. But it's fresh because we kind of keep about different things. But we want the listeners, and if you're listening to this, please suggest different topics to discuss. Like, you're all, really, really important to the process, and that's why I still enjoy doing this, because it allows you to reach more people rather than
get it fresh. Well, demographer is what we need. It's one really good guest, and I'm sure we can come up with other people. So, if people want to connect with you guys, best way?
Just Google Rethink Investing and choose your method that way.
All right.
Yeah.
Pretty simple.
Yeah.
Well, thank you, Scott. I've enjoyed the 50th episode and recording 50 episodes. I must admit, there's people have asked me, how do I know so much about property? It's because I get to do this sort of stuff, right? It's a great school for me, chatting with very successful people in property, and the outcome of it is that I get to learn lots of cool stuff. So thank you very much. That's Inside Commercial Property. I'm Phil Tarrant, chatting with Scott O'Neill, founder, director of Rethink Group. Go and check these guys out, rethinkinvesting.com.au. We'll see you again next time. Until then, bye-bye.